Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at the VanEck Semiconductor ETF, ticker SMH.
If you find our talks useful, please consider subscribe, like, and comment underneath. And speaking of useful, we have a quick note before diving in.
Right, a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
All right, let's move into the wealth building context, because
Okay.
before we get into the heavy math today or, the technical charts, I really want you to zoom out and think about this.
Yeah, context is everything here.
Exactly. Because the most valuable real estate in the modern global economy, it isn't a penthouse in Manhattan. And it isn't a high-rise in Dubai. It's a microscopic slice of silicon that is currently being fought over by literally every major corporation and superpower on Earth.
It really is the foundation of the new economy.
Right. And today we're looking at who actually owns that real estate, and more importantly, how you can position yourself to capture its value without getting completely wiped out.
Which is a very real risk, yeah.
So we need to understand why the semiconductor sector is the absolute bedrock right now. We're looking at this massive infrastructure inflection driven by artificial intelligence. But what's fascinating is that this rally, it's no longer just the NVIDIA show.
No, not at all. It's broadening out.
Yeah.
And when you're looking at long-term wealth building, you always want to identify the bottlenecks.
The bottlenecks.
Right, because bottlenecks dictate pricing power. I mean, if you control the bottleneck, you control the margins.
Yeah.
And the SMH ETF gives you this highly concentrated exposure to the picks and shovels of the AI boom.
Like the California gold rush?
Exactly like that. You don't necessarily want to bet your life savings trying to guess which specific software startup is going to strike gold. You want to be the one selling the shovels, the pickaxes, the tents.
Right, to every single miner who shows up.
Exactly. And right now, the physical stack of AI, the actual silicon, the memory, the advanced packaging, that is the most critical constraint in the world. And the companies inside this ETF, they operate as insurmountable oligopolies. They have these massive intellectual property barriers.
Okay, I have to push back on that a bit.
Sure, go ahead.
Because as a naturally cautious investor, I hear a word like insurmountable and my radar just immediately goes off.
I get that.
I feel like I've seen this movie before. You look back at the year 2000, the dot-com bubble, everyone bought the hype that the internet was going to change the world.
Which, to be fair, it did.
It did. But the infrastructure got massively overbuilt, valuations totally detached from reality, and then the crash wiped people out. So I need to know why this isn't just another speculative fad. Are there actual durable moats protecting these companies, or are we just buying into a hype cycle that ends in tears?
Well, it's a completely valid comparison, and you should absolutely be cautious.
Ollie,
But the difference here comes down to the unforgiving constraints of physical reality.
what do you mean by that?
Well, during the dot-com era, companies were being valued on, eyeballs and clicks. Software can be replicated in seconds. But today, the moat protecting these semiconductor giants is grounded in advanced physics and chemistry.
Like the actual manufacturing process.
Exactly. We are talking about advanced packaging techniques and fiber optics that take decades and tens of billions of dollars to master. A startup in a garage simply cannot replicate a state-of-the-art foundry.
Because we aren't just talking about a warehouse with some conveyor belts. I mean, these fabrication plants, or fabs, they're essentially the most complex manufacturing facilities ever created by humanity.
Yes. They require environments that are thousands of times cleaner than a surgical operating room.
Precisely. You are manipulating matter at the atomic level. And because of those extreme physical and capital constraints, the very few companies that can actually produce these high-end chips have massive durable pricing power.
So they dictate the terms, not the buyers.
Exactly. And let's look at the fundamentals. Because if we want to prove these aren't just dot-com illusions, we have to step away from the economic theory and look at their actual balance sheets.
And the numbers right now are just staggering. I was digging into the revenue breadth, and like we said, it's not just a single mega cap carrying the sector anymore.
Right.
Every single constituent in the primary semiconductor index gained at least 14% over the last month alone. That shows genuine broad-based strength.
It really does. Look at Taiwan Semiconductor, for example.
TSMC.
Right, TSMC. They make up about 10.5% of this ETF. They just reported revenue up 40.6% and net income up 58.3%.
Wow. We really need to pause and visualize what that number means. Yeah, please do.
Because to put a 40% growth into perspective, TSMC isn't selling a digital subscription where you just copy and paste code.
No.
They are building microscopic physical objects in multi-billion-dollar factories, scaling physical manufacturing by 40% in a single year at that size. It's like doubling the size of a major city overnight.
It completely defies the laws of traditional industrial growth, and their management just raised full-year guidance to above 30%.
Incredible.
And, it's not just the foundries. Advanced Micro Devices, or AMD, their revenue hit $10.3 billion, which is a 38% increase.
Right.
But the real standout was their data center revenue. That surged 57% to a record $5.8 billion. They completely crushed estimates for their Q2 guidance, putting it at around $11.2 billion.
And the reason we're seeing these massive beats is because of a fundamental shift in how artificial intelligence operates, right? Specifically, this move toward what is called agentic AI.
Exactly. Agentic AI is the engine driving this entire demand shock.
Let's break that down for the listener because it's crucial. Traditional AI is like a vending machine. You put in a prompt, you wait a second, you get one answer back, the transaction is over.
Right, very linear.
But agentic AI is like hiring a digital employee. You give it a complex, open-ended goal, and it goes out, searches the web, realizes it hit a dead end, loops back, tries a new tool.
It keeps running autonomously.
Exactly, for hours or even days. That continuous looping action requires an unbelievable amount of processing power. It is literally melting down servers and draining memory supplies.
That is the perfect way to visualize it. The computational load just doesn't stop. And to give you an idea of the severe supply constraints that this is causing, Micron's customers are currently only getting 50% to two-thirds of the memory they actually ordered.
Wait, only half?
Only half. Imagine running a massive cloud infrastructure service, and your main supplier tells you, well, you're only getting half of what you need to operate.
That's a nightmare for them.
It is. But when demand outstrips supply that aggressively, the chip makers get immense pricing power.
But here's my practical concern. I'm looking at their balance sheets, and my immediate fear is shareholder dilution.
Okay, how so?
Well, if they are making so much cash, but they also have to build these massive $20 billion new factories to meet this hyperscaler demand, are they issuing stock and crushing our equity to fund all this, or taking on massive debt?
And that right there is the crucial difference between today and the year 2000.
Okay.
Back then, telecom companies took on mountains of debt to lay fiber optic cable, which eventually bankrupted them. Today, these semiconductor companies have incredibly robust financial health, characterized by massive free cash flow.
So they aren't debt heavy.
Not at all. AMD's Q1 free cash flow just tripled to a record $2.6 billion.
Yeah.
And if you look at the memory giants like Micron, Samsung, SK Hynix, who collectively produce 90% of the global DRAM supply,
Right.
they are seeing their operating expenses rise only modestly while their pricing is absolutely surging.
So they're taking all that extra profit and plugging it right back into construction.
Exactly. It creates a windfall of cash. They are completely self-funding their capital expenditures. They do not need dilutive capital raises. They're funding their own exponential growth with cash from operations, which protects the shareholders.
That brings us to the catalyst timeline. Because knowing these companies have fortresses of cash is great, but as investors, we need to know what upcoming events will actually trigger the deployment of that cash and move the stock price next.
Exactly.
Q1 earnings are in the rearview mirror, and obviously they featured massive beats. So what are the immediate triggers you're watching?
Well, the very next fundamental triggers are going to be the Q2 pre-announcements in late July and August. We need to listen very closely to what these companies say about two specific things:
Which are?
memory pricing sustainability and the supply constraints on AI accelerators. And beyond earnings, there are major product launches. We're heavily watching the ramp-up of AMD's Helios rack scale systems and their MI450 GPUs in the second half of 2026.
And those aren't just single chips, right?
No, these are giant interconnected clusters of processors. Those are critical operational milestones that will test their ability to actually take market share away from NVIDIA.
There's also some fascinating rumor and speculation moving the needle right now.
Oh, absolutely.
The industry is buzzing about the imminent formalization of a foundry agreement between Apple and Intel, essentially having Intel manufacture processors for U.S. devices.
Which would be huge.
Huge. If that actually goes through, it permanently re-rates Intel's foundry business because it shows Apple wants a secure domestic supply chain. We're also seeing SK Hynix fielding equipment financing deals for ultraviolet lithography machines to ramp up their output.
Yeah, and that points toward potential strategic equity investments coming from the big tech hyperscalers directly into the holdings of this ETF.
Wait, so the hyperscalers, the Googles and Microsofts of the world, are so desperate for silicon that they might literally start financing the manufacturing equipment for their suppliers.
Exactly. That is a level of demand we rarely see in any industry. But, you also have to balance those microcatalysts against the broader macroeconomic factors.
Right.
On the positive side, we had very strong April payrolls, driving a broad risk-on environment.
Right. A strong economy means corporate IT budgets hold up.
Exactly, which means they keep buying servers.
But let's look at the negative macro risk, because, again, as a risk-aware investor, I cannot ignore geopolitics.
Of course not.
The Strait of Hormuz negotiations remain a massive binary event for the global economy. I look at the Strait of Hormuz like a choke valve on a high-performance engine.
That's a good analogy.
No matter how incredible the AI chips are, no matter how much free cash flow AMD generates, if those negotiations fail and we see a $200 barrel of oil, that choke valve closes.
Yeah.
It completely crashes the corporate capex party. Energy costs would skyrocket, inflation would rebound, and the capital required to buy these massive AI servers would vanish overnight.
It's a very real overhang. And it's a great reminder that these stocks don't exist in a vacuum. A $200 oil spike would absolutely impact the demand side of the equation, regardless of how innovative the tech is.
Now let's pivot to the chart.
Right.
Because we've established the catalysts and the economic context, but we need to examine how the market is physically trading these expectations right now.
And looking at the technicals, this ETF is in a textbook parabolic momentum phase.
Parabolic is the word.
It surged 32% in April alone, closing at $549.76 on May 7th, which is right against its 52-week high of $549.88. That is a massive, definitive breakout from the consolidation phase we saw back in mid-March.
Yeah, and if you look at the broader sector index, ticker SOXX, it climbed over 45% in a single month. To put that in perspective, that is the strongest 25-day rally the sector has seen since 1999.
And that 1999 comparison is exactly why I get nerved. When a chart goes vertical like that, you have to look for the underbelly of the rally.
And right now, implied volatility is rising alongside the price. That means upside bets call options are becoming incredibly expensive because the market expects violent price swings.
That's true.
And I'm seeing some highly concerning signals on the downside. On Reddit's R stocks, there is highly unusual put activity. Retail traders betting the price will fall.
Interesting.
But more notably, Michael Burry, the investor who famously shorted the 2008 housing market, has been buying SOXX put options expiring in early 2027. If the retail contrarians and the so-called smart money are both buying puts, are they betting on a crash? Because when Michael Burry places a bet like that, my instinct is to lock in my gains and run for the exits.
I completely understand the instinct, but it's really crucial to understand the mechanics of the options market here.
Right.
When you see big institutional players buying puts, it doesn't necessarily mean they are outright shorting the sector and betting on a crash.
What else would it be?
Often, they are covertly hedging their long exposure. Let's say an institution is sitting on multi-billion-dollar gains in NVIDIA or TSMC. They will buy puts as an insurance policy in case that macro choke valve you mentioned gets triggered.
Oh, I see.
Alternatively, they might be playing what's called a volatility crush.
A volatility crush. Break that down for us. How does that work?
Sure. Because implied volatility is so high right now, option premiums, the actual cost to buy the contract, are extremely bloated.
Right.
Sophisticated traders will structure complex trades to profit when that volatility inevitably normalizes and the premiums deflate.
Right.
They make money on the air coming out of the option price, regardless of whether the stock price itself actually crashes. So Burry's position might be an insurance policy or a volatility play, not necessarily a prophecy of doom.
So what does market sentiment look like? Because the chart shows explosive buying, but we need to look under the hood at who is actually doing it. Is this just retail euphoria, or is institutional positioning driving the bus?
Well, quantitatively, sentiment is overwhelmingly bullish, but as we noted with the options, there's an undercurrent of macro caution.
Right.
The news flow is completely dominated by massive positive catalysts. AMD's blowout quarter, the Intel and Apple deal rumors, And Corning announcing a $3.2 billion optical tech partnership with NVIDIA. Analysts are just scrambling to upgrade their target.
Yeah, I saw Goldman Sachs and Bernstein both upgraded AMD.
Exactly. And JP Morgan explicitly noted that we're seeing a structural inflection in server CPUs.
The retail accumulation is definitely massive right now, though. In fact, retail buying for Micron just hit a 2-year high. But I have to push back here.
Okay.
In market history, when retail buying hits a multi-year high, that is usually the classic shoe shine boy moment.
The top, essentially.
Right. It's the signal that the last person has boarded the train, the hype has peaked, and there is absolutely no one left to drive the price higher. As a practical investor, a 2-year high in retail buying is a glaring red flag.
It is a classic contrarian indicator. And, in a vacuum, you'd be right to be worried. But you have to look at the institutional flows to get the full picture.
What are they doing?
The institutional flow is currently split. Broad ETFs like SMH are seeing historic massive inflows. But the tactical smart money is actually pulling outflows from core index funds and rotating that capital into very niche infrastructure plays. So they aren't leaving the AI space. They're just getting more selective.
So they aren't cashing out, they're just aiming with a sniper rifle instead of a shotgun.
Exactly. And regarding your point about retail being the last on the train, Mizuho analysts pointed out something critical about the mechanics of this sector.
What's that?
In historic memory upturns, being overweight yields massive profits much longer than people expect.
Why is that?
Because of supply inelasticity. Remember how complex these fabs are? New fabrication capacity simply cannot be added fast enough. Even if every retail investor knows the trend, the physical inability to create more chips forces prices higher for years. Now let's talk about the risks. Because acknowledging that extreme retail bullishness naturally leads us to the downside. What happens to this thesis if the music stops? We need to look at the bear case, starting with what's called the peak earnings trap.
I want to highlight this because for anyone listening, this might be the single most important concept to grasp today.
Absolutely.
If you look at a company like Micron, their forward PE, or price-to-earnings ratio, is sitting around 7.3.
Which sounds great.
Right. On paper, that looks incredibly cheap. You think, wow, a massive tech company in an AI supercycle trading at a 7 PE, that's a steal. But it is an illusion.
The complete illusion.
That low PE is being driven by a phenomenon analysts are calling memflation, memory price inflation. Memory prices are currently inflated by about 125% because of the extreme shortages we talked about.
That is the aha moment right there. The earnings look massive today because the price of the commodity they sell is artificially spiked due to a temporary shortage. But memory is a highly, highly cyclical business. Eventually, hyperscaler capex will peak, or those new multi-billion-dollar fabs will finally come online and flood the market with supply.
And when that happens, the 125% memflation just vanishes, profit margins compress violently, and the math flips.
Yep.
The PE multiple will expand inversely as earnings drop, triggering a severe repricing of the stock. BTIG analysts are warning that the magnitude of the current markup strongly resembles 1999, and they see a potential 25 to 30% sector correction when that memflation cycle turns.
Exactly. That is why blindly buying based on a low PE in a cyclical industry is so dangerous. But there's also a massive structural risk here regarding concentration. This ETF is dangerously top-heavy.
It really is.
NVIDIA alone makes up around 17% of the fund. Add in massive weights for TSMC and Broadcom, and you have a severe concentration problem.
Think of this ETF structure like a tied-together mountain climbing team. You have NVIDIA at the front pulling TSMC, Broadcom, and a bunch of smaller chip makers up this parabolic mountain. While they're climbing, the blind, passive ETF inflows act like a rising tide. Money comes into the ETF, and the algorithms automatically buy every stock in the basket, lifting all boats.
Right, even the lower quality commoditized chip makers get pulled up the mountain.
Exactly. But here is the massive danger of passive ETF liquidation. The algorithms don't think, they just execute. If NVIDIA slips and its stock drops, investors panic and sell the ETF.
Which triggers a chain reaction.
Right. The algorithms are then forced to blindly liquidate the entire basket. They don't care that TSMC has 40% revenue growth, they just sell. NVIDIA pulling the rope drags the whole team right off the cliff.
That is the double-edged sword of passive investing. Momentum works identically in both directions. When the algorithms are forced to liquidate, fundamentals basically go out the window in the short term.
So with everything on the table, what's the final verdict? We have to weigh the durable oligopoly moats, the insurmountable physical barriers to entry, and the massive free cash flow against that peak earnings inflation risk and the concentration fragility of the mountain climbing team.
Well, based on the underlying research, the bullish score sits at an 8 out of 10.
Okay, an 8.
Yeah. Our long-term view is that this is a 12-month hold. The sheer broadening of this rally, moving from just GPUs into CPUs, memory, and fiber optics, it proves that this is a multi-year CapEx supercycle, not a fleeting software fad.
Right.
And honestly, using the ETF structure is actually the smartest way to capture this macroeconomic theme because it completely removes the execution risk of picking a single company that might stumble. Investors should hold to ride this supercycle, but, and this is the critical takeaway, you must actively monitor the market for late-stage CapEx exhaustion or a peak in that memflation cycle as we look out toward late 2027.
As you look at your own portfolio, just ask yourself, if the mountain climbing team does slip, do you have enough conviction in the safety rope of that underlying free cash flow to hold on? That is the real test of a supercycle.
Well said.
Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.